Imagine looking at your bank app right now and watching your balance tick up by a fraction of a cent every single second.
Just constantly moving.
Right, not every 2 weeks. Every single second. I mean, if you make, say, a $5,000 monthly salary, that is about 0.0001 flowing into your digital wallet with literally every tick of the clock.
It's hard to even visualize at first.
It is. You go grab a coffee, and by the time you're back at your desk, you've visibly earned enough to pay for it.
Yeah.
There's no more waiting for payday. The money is just, it's just there.
Which completely shatters the fundamental rhythm of how we experience earning a living, right?
Exactly.
We are so conditioned to the waiting game, to the artificial scarcity of that 2-week pay cycle. The psychological impact of having instantaneous access is honestly hard to overstate.
So welcome to the deep dive. Our mission today is to explore this, what they're calling the PayFi, or payment finance revolution of 2026.
Yeah, and we've got a massive stack of sources today.
We do. We're pulling from DWF Labs' recent research on real-world asset tokenization, along with some really comprehensive market analyses of the ZBCN network and its native token, ZBCN.
It's a lot of ground to cover.
It is. We're looking at how a technology called streaming money is attempting to completely rewire the $85 trillion traditional financial system.
A massive undertaking.
Oh, yeah. And we'll get into exactly what the pivotal March 2026 token unlock means for the future of this entire space.
Because we are literally talking about replacing batch-processed financial cycles that have been, well, they've been the unshakable global standard since the invention of the modern corporate payroll department.
Okay, let's unpack this core innovation first. ZBCN calls it their continuous settlement protocol.
Or money streaming.
Right, money streaming. Now, the technical breakdowns in our sources literally provide the calculus formula they use to calculate this liquidity over time.
Yeah, the integral formula.
Right, the integral from 0 to t of RDT. But let's translate that math into English for a second for you listening.
Probably a good idea.
Instead of calculating a lump sum at the end of the month, the smart contract essentially cuts your salary into millions of tiny fraction of a cent slices and drips them into your wallet automatically.
Just a continuous drip.
Exactly. But I have to play devil's advocate for you and for the listener here. Why does getting paid by the second actually matter?
It's a fair question.
Right. I mean, can't you just budget for 2 weeks like a responsible adult? To me, traditional payroll is like waiting for a giant bucket to fill up before you're allowed to take a drink.
Yeah, that's a good way to put it.
Whereas the streaming model is like turning on a constant faucet. So is the faucet really that necessary?
Well, what's fascinating here is if we look at the underlying economic reality of that bucket, the necessity becomes really clear.
How so?
Because in the legacy system, when you work for 2 weeks or a month before getting paid, you are essentially forced to provide an interest-free loan to your employer.
Oh, wow. I never actually thought of it as a loan.
Most people don't, but your labor has already generated value for the company, right? But they hold the capital.
Right. I've done the work on day 1, but I don't see the money for that specific day's work until day 14.
Exactly. And they get to earn yield on that cash or use it for operational liquidity while you just sit there and wait.
That is, wow. Yeah.
And that lag is where immense financial friction lives. ZBCN's streaming model mathematically eliminates that lag.
Because the moment you earn it, you have it.
Yes, you have the financial flexibility to use it immediately. And the practical result of this is profound.
It gets rid of the payday loans, doesn't it?
It entirely eliminates the need for predatory payday loans or early wage access products, the ones that charge exorbitant fees just to give you your own money a few days early.
Which is such a massive industry. And what really struck me in our source is that this isn't just some niche tool for like crypto native freelancers getting paid in obscure tokens anymore.
No, not at all.
Through ZBCN's compliant application, it's called WageLink, this is hitting traditional Web 2 companies. They are processing real-world, everyday payroll.
Which is the true test of the tech.
But that brings up a massive friction point. I mean, you can have the coolest, mathematically perfect faucet in the world, but if you can't connect it to the plumbing of an $85 trillion house...
It's completely useless.
Exactly. How do you get massive, entrenched legacy companies to change the plumbing?
Well, if we connect this to the bigger picture, that institutional integration is where the narrative shifts from theoretical tech to real-world infrastructure.
Right.
Because in December 2025, ZBCN achieved a milestone that fundamentally altered their trajectory. They joined the Nacha Payments Innovation Alliance.
Yeah. And just for the listener, NACHA is the governing body for the massive ACH network in the United States.
It's a huge deal.
So by joining this alliance, ZBEC is suddenly sitting at the exact same table as JP Morgan, Wells Fargo, and ADP.
They aren't outside the castle throwing rocks anymore.
No, they are inside the room where the traditional payment standards are actually written.
And that seat at the table provides the institutional legitimacy required for enterprise adoption. It signals to legacy players, this isn't a rogue crypto experiment.
Right, it's a compliant upgrade to existing rail.
Exactly. And they followed that up by integrating with NatPay, which is a processor handling $170 billion annually for hundreds of thousands of clients.
That's a massive integration.
It is, because it allows employers to route payouts through traditional bank rails or Web3 rails from a single unified platform. They don't have to choose one or the other.
But here's where it gets really interesting to me, looking at these sources. Because they aren't just relying on polite partnerships with TradFi.
No, they are much more aggressive than.
ZBEC actually created an investment arm called Payroll Growth Partners. And their strategy is wild. They are physically buying up traditional legacy payroll companies.
Just acquiring them outright.
Yeah, to upgrade their tech from the inside out. It's literally like a brand new tech startup buying up fleets of old yellow taxi cabs just to force them to install GPS and use an app.
It's a brilliant move, honestly. Instead of waiting for the legacy market to slowly adopt their blockchain backend, they are acquiring the market share and installing the backend themselves.
It's a vertically integrated strategy.
Totally bypasses the traditional sales cycle. And while they're executing that in the US, they are simultaneously addressing a completely different challenge globally.
Right, the multi-chain expansion.
Yeah, the sources highlight their deployment on the Stellar network to target workers in 170 countries, people who lack traditional banking access entirely.
Which is where the MoneyGram integration comes in, right?
Exactly. They are integrating with MoneyGram, meaning someone getting paid in streaming USDC can walk into a physical location and convert that digital stream directly into local fiat cash in their hand.
But I mean, the underlying blockchain architecture has to be massive to handle this.
It does.
If you try to process a fraction of a cent every second for 50,000 users on a main chain like Ethereum or even Solana,
That work congestion would be a nightmare.
yeah, the gas fees would eat the entire paycheck in 5 minutes.
And that is precisely why they built their own modular architecture, the Nautilus L3 chain.
Okay, an L3.
Right. A layer 3 chain sits on top of existing blockchains, but is specifically optimized for one singular purpose. In this case, high-speed, high-volume enterprise settlements.
Who batches them?
It batches thousands of these microtransactions off the main network, ensuring the cost per transaction remains fractions of a penny, which is the only way a continuous settlement model is economically viable.
Okay, so ZBEC has effectively built the plumbing to bridge Web 2 payroll and Web 3 continuous settlement. But the obvious next question is how this fits into the broader financial landscape.
Because none of this is happening in a vacuum.
Right. We need to look at the massive shift happening in 2026 around real-world assets, or RWAs.
The whole market is pivoting.
We have this fascinating panel discussion from DWF Labs in our stack today, featuring experts from Centrifuge, Falcon Finance, and Xstocks.
And their consensus is pretty absolute.
It is. They all agree that 2026 is the proof year. Generic, unsustainable DeFi yield is out. Institutional on-chain yield backed by real assets is the only game in town.
The market has just matured past that early speculative phase. Institutions are demanding products that behave like real financial primitives, with reliable pricing and deep liquidity.
I have a major question about this proof year concept, though. If the tokenization technology works, why the hesitation?
What do you mean?
Like, can't we just tokenize everything right now? Real estate, art, intellectual property, and just let the free market sort it out?
Well, this raises an important question, and it's exactly what Artem Tolpachev from Falcon Finance cautioned against in the DWF panel.
Okay.
He made a very blunt point about the necessity of price discovery. His argument is that you absolutely should not tokenize assets that lack an active liquid market.
Give me an example of that.
He used examples like an illiquid Dubai villa or collectible cars or rare emeralds.
Right, because putting a digital token on a mansion doesn't magically make it easier to sell.
Exactly. If it takes 6 months to find a buyer for a physical villa, tokenizing it into 1,000 pieces doesn't create a liquid secondary market for those pieces.
It just adds a new layer of smart contract and oracle risk on top of a highly illiquid asset.
Exactly. The core debate in the RWA space right now is composability versus ownership. How do you respect the strict legal ownership of a regulated physical asset while still allowing it to move freely and be used as collateral in DeFi.
That's a huge hurdle.
Tolkachev's point is that early tokenization efforts failed because they focused on the wrong assets.
And this is where ZBCN's approach in 2026 really clicks for me. Because they aren't trying to tokenize static, highly illiquid assets like a random building.
No, they're tokenizing the flow of highly liquid capital.
Right. Wages in USDC are already the most liquid assets on the planet. By tokenizing the payroll stream, they are taking something that already has perfect price discovery. I mean, $1 is $1.
Exactly, and simply making it composable.
And they are solving the regulatory side by building on permissioned institutional rails. The sources detail their partnership with Lattice Finance to launch the first MasterCard on the Canton network.
And the Canton network is a vital piece of this puzzle. It's a privacy-enabled blockchain designed specifically for institutional finance.
Backed by some heavy hitters, right?
Huge entities like JP Morgan and DTCC. Traditional finance cannot operate on fully public blockchains where every transaction is visible to competitors.
Obviously not.
So by operating on Canton, ZBCN connects its payment streaming to regulated, privacy-preserving settlement rails.
Which perfectly aligns with the DWF Labs prediction that 2026 growth will concentrate almost exclusively around products with clean, compliant operational rails.
Precisely.
So the infrastructure is sound, the institutional partnerships are in place, and the macroeconomic trend of tokenizing liquid flow is validating their model.
It's a strong foundation.
This brings us to the actual economics of the network itself. Let's talk about the ZBCN token. Because March 2026 is described across all our sources as the most critical juncture for this asset.
We are looking at a massive supply shock.
Right. It's a defining moment. On March 16th, 2026, the final scheduled token unlock concluded.
This was a $2.2 million unlock.
Yeah, that ended the vesting period for early backers, investors, and team members, meaning the era of dilution is officially over.
Which is huge for token holders.
They have a fixed maximum supply of 100 billion tokens, and as of this month, roughly 99% of those are unlocked and circulating.
The network has transitioned from an inflationary startup phase into a fully mature deflationary model.
So what does this all mean for the token's value?
Well, this shift completely alters the value proposition. In the early days, inflationary rewards are used to bootstrap the network.
To get people in.
Right. But once the supply is fully circulating, the protocol must rely on organic, utility-driven demand. And for ZBCN, that demand is driven by an automated buyback engine.
Let's trace the actual life cycle of how that works under the hood. Because the concept of a buyback and burn gets thrown around a lot in this space.
It does, often without much substance.
Right. But from what I understand in the technical docs, a portion of the protocol revenue, whether that's from payroll processing fees, transaction fees when someone swipes their ZBCN card, or enterprise contracts, is swept by a smart contract.
Correct.
That contract then interacts with an automated market maker to buy ZBCN directly off the open market and immediately sends those tokens to a null address, permanently removing them from existence.
That is the exact mechanism, and it creates continuous programmatic buying pressure that is entirely decoupled from market sentiment.
So it doesn't matter if Bitcoin is up or down.
Exactly. The buying happens whether the crypto market is in a bull run or a bear market, as long as people are receiving their payroll and using their cards.
That's a powerful baseline.
And according to the analysis, this buyback volume has been growing at an annualized rate of over 70%.
Wow. Let's look at the math on that demand, actually. The sources provide a really clean conceptual formula for it. Demand equals U times ARPU.
Right, the user metric.
The number of monthly active users multiplied by the average revenue per user. If you increase either of those variables, the buyback engine burns more tokens.
And ZBCN currently has about 50,000 monthly users, and their projections anticipate that doubling by the end of 2026.
So every time those users pay a fee or swipe their MasterCard, real-world revenue is generated to fuel that smart contract burn mechanism.
Yes, and they are tying this all together in their new super app. They are consolidating payroll, treasury management, and retail spending into one single interface.
The brilliance there is the incentive structure, though.
Oh, absolutely.
Because if you stake your ZBCN inside the super app, you unlock higher cashback tiers on your MasterCard and lower fees on your payroll processing.
It creates a massive incentive for the user to hold the token rather than sell it,
effectively removing even more supply from the open market. And the smart money clearly sees this mathematical shift coming.
You can see it in the on-chain data.
Yeah, looking at the Blockchain Explorer data in our stack, Tier 1 wallets, meaning massive wallets holding more than 100 million tokens, actually increased their positions by 12.4% in early 2026.
That kind of accumulation by top-tier wallets is a classic indicator of institutional positioning.
They aren't trading for a quick flip based on a news cycle.
No, they are accumulating ahead of a definitive supply shock to capture the long-term protocol-generated yield.
Okay, I have to ground us here for a second. A deflationary token with a programmatic buyback engine fueled by real-world payroll sounds amazing on paper.
It does.
But we have to look at the actual realities in the charts. I'm looking at the technical analysis from the DWF report for February and March 2026.
The current consolidation phase.
Yeah, it shows ZBCN in a high-volume consolidation zone, bouncing between 0.00000005.
Right.
And they mentioned something called a bullish twin peak on the Awesome Oscillator. If I'm reading this right, the Awesome Oscillator measures momentum, and a bullish twin peak basically means the selling exhaustion has ended. The short-term buying trends are starting to aggressively outpace the long-term averages.
Exactly. The technical setup suggests a breakout is pending, particularly as it faces a major psychological resistance barrier at 0.00032.
Okay.
If it breaks through that resistance on high volume, backed by the narrative of the token unlock completing, the indicators point toward a sustained upward trend.
The charts are hinting at a breakout, the tech works, the partnerships are massive, but I see a massive bottleneck here.
Let's hear it.
This all sounds like a perfectly oiled machine, but we know crypto. What's the risk? If I'm a giant like Gusto or ADP, and I have billions in capital and millions of captive clients, what is stopping me from just copy-pasting this continuous streaming tech and crushing ZBCN?
You've just identified one of the three major risks highlighted by the analysts in our sources.
Okay, so it's a known threat.
Yes, the legacy giants are a looming threat. ZBCN is innovating rapidly, but if streaming payroll truly becomes the undeniable new global standard, the ADPs of the world won't just sit idly by.
They'll just build it themselves.
Right. They have the distribution networks already in place. This is precisely why ZBCN's strategy of physically buying legacy payroll providers through their growth partners arm is so aggressive.
They're trying to outrun them.
They're trying to dig a moat and capture market share before the sleeping giants fully wake up to the Web3 threat.
That makes the race against time very real.
Yeah.
What are the other red flags in the analysis?
The second major risk revolves around opaque metrics. ZBCN claims 50,000 users and hundreds of companies, but hard, publicly verifiable data on the total dollar volume of payroll being processed on-chain is not fully transparent.
So we're taking their word for it on some of this.
To a degree, yes. Without knowing the exact enterprise revenue, it is very difficult for analysts to calculate exactly how powerful that deflationary buyback engine really is.
If the buyback volume doesn't outpace the natural selling pressure of early investors taking profits, the price will stagnate.
Regardless of the deflationary mechanics.
That is a crucial point. A buyback engine is only as strong as the revenue feeding it. And there's one more risk in these reports, which they call the $1 billion anchor.
This is a really important one for retail investors to understand.
I think the best way to visualize this is to think of market cap like a massive pizza.
Okay, I like this analogy.
ZBCN has a total supply of 100 billion tokens. They've sliced the pizza into 100 billion incredibly tiny pieces. Because of that sheer volume, the unit price per slice is very low, currently a fraction of a cent.
Right.
It tricks the brain into thinking, oh, it can easily jump to 1 cent. But achieving a $0 1 cent price point requires a $1 billion fully diluted market capitalization.
That's a lot of capital.
Getting to 10 cents requires a $10 billion market cap. It requires the exact same amount of capital to buy the whole pizza, no matter how tiny you slice it.
It's the unit bias illusion.
Exactly. It distorts the perception of what kind of massive capital inflow is actually required to move the price significantly.
That is a vital reality check. The psychological allure of a low unit bias often blinds investors to the heavy gravity of the market cap.
So true.
The ultimate verdict from the market in 2026 is that a deflationary token only appreciates in value if there is actual, verifiable, real-world utility driving those buybacks.
The transition from an inflationary startup to a revenue-driven utility network is complete. Now, the market requires flawless execution.
Exactly.
So, to summarize this incredibly deep journey we've been on, we started with the mind-bending concept of getting your paycheck streamed to your phone by the second, mathematically eliminating the interest-free loans we've been giving our employers for decades.
The faucet over the bucket.
Right. We looked at how Zebek is bridging the gap into the $85 trillion TradFi world by joining the Notch Alliance and physically buying up legacy payroll fleets to upgrade them from the inside out.
Upgrading the plumbing.
We contextualize this within the broader 2026 RWA landscape, where the market is rejecting illiquid tokenized mansions in favor of liquid, composable, and compliant assets like wage flows.
The proofier.
And finally, we broke down mechanics of the March 2026 tokenomics shift, where ZBCN locks its 100 billion supply and relies entirely on user adoption and super app revenue to fuel its deflationary buy and burn engine.
It really serves as a textbook example of how the narrative in decentralized finance has matured.
Oh, absolutely.
We have moved far beyond generic yield farming and speculative hype and are finally building actual usable market infrastructure that interfaces directly with the legacy financial system.
It really is a massive leap forward, but I want to leave you, the listener, with a final thought to mull over on your own.
Let's hear it.
We've talked so much today about the mechanics, the smart contracts, the tokenomics, and the market cap. But let's step back and think about the human element of this technology.
Okay.
If this PayFi revolution truly succeeds, and we all eventually get paid by the second, how does that change human psychology?
That's a deep question.
Think about it. So much of our modern culture is built around the anticipation of payday. If you never have to wait for that Friday deposit again, does the concept of the weekend splurge disappear entirely? If your wealth is constantly visibly ticking upward in real time on your phone, how will that instantaneous access change how you value your own labor, how you budget your life, and ultimately how you choose to spend your time?
It changes everything.
It really does. Thank you for joining us on this deep dive into the sources. Keep questioning the world around you, and we will catch you next time.